In this lesson, we're diving deep into the Relative Strength Index, or RSI. RSI is one of the most popular technical indicators used by traders to gauge market momentum and identify potential buying or selling opportunities. Let's get started. So, what exactly is RSI? The Relative Strength Index is a momentum oscillator that measures the speed and change of price movements. It was developed by J. Wells Wilder and is used to identify overbought or oversold conditions in the market. RSI is calculated using the following formula, where RS, or relative strength, is the average gain of up periods during the specified time frame divided by the average loss of down periods during the specified time frame. The RSI oscillates between 0 and 100. When the RSI is above 70, it indicates that the asset is overbought and may be due for a correction. Conversely, when the RSI is below 30, it suggests that the asset is oversold and could be poised for a rebound. These zones help traders identify potential reversal points in the market. Let's look at an example to better understand how to interpret RSI values. In this chart, you can see the price movements of a cryptocurrency along with the RSI values plotted below. Notice how the RSI moves in response to the price changes. When the RSI enters the overbought zone above 70, it often signals that the price may soon decline. Conversely, when the RSI dips below 30 into the oversold zone, it suggests that the price may soon rise. If you want to see Relative Strength Index in action for yourself, then sign up for a free trading account on Kraken and get access to this and hundreds more popular trading indicators. Now, let's discuss how you can apply RSI in your trading strategy. To start off, you can identify overbought and oversold conditions. Look for RSI values that are above 70 to identify overbought conditions and values below 30 for oversold conditions. And then you can confirm with other indicators. Use RSI in conjunction with other technical indicators to confirm potential trade signals. Next, you can adjust time frames. Experiment with different time frames to see which works best for your trading style. Shorter time frames may provide more signals, but they can also be more volatile. To summarize, RSI is a powerful tool for measuring market momentum and identifying overbought and oversold conditions. By understanding how to calculate and interpret RSI values, you can enhance your trading strategy and make more informed decisions. Thank you for joining me today. Remember to practice what you've learned and keep refining your trading skills. See you in the next lesson.